Let's talk about perfecting a security interest now. This is hefty. It's a lot of stuff, but we're getting through it. We're having a good time while doing it. Keep it up. Stretch as you need to. Get an energy drink, coffee, whatever it is you need to do. Perfecting a security interest is essential for a creditor to obtain maximum priority over other parties who may have an interest in the same property. Now, this is going to ensure that the creditor's rights are protected in case the debtor defaults on their obligations. We've got 5 primary methods of perfection. First, in order to perfect, you can file. Filing a financing statement, such as that UCC-1 form with the appropriate public office, provides notice of the security interest to third parties. For example, a bank lends money to a business and takes a security interest in the business's equipment. The bank files a UCC-1 financing statement to perfect its interest. Next up, you could also take possession of the collateral. The creditor can take physical possession of the collateral, which is common for tangible assets like vehicles or artwork. For example, a lender provides a loan to an art collector, taking a security interest in a valuable painting. The lender takes possession of the painting to perfect its interest. Next up, control. In the case of certain types of collateral, such as investment property or deposit accounts, the creditor can perfect its interest by obtaining control over the asset. For example, a bank lends money to a company and takes a security interest in the company's investment account. The bank perfects its interest by obtaining control over the account. We've got automatic and temporary perfection. What's the difference here? Well, some security interests are perfected automatically upon attachment, such as a PMSI in consumer goods, or small-scale assignment of accounts receivable. For example, a consumer buys a refrigerator on credit from an appliance store, and the store retains a security interest in the refrigerator. The store's security interest is automatically perfected upon attachment. Now, temporary perfection. In certain situations, a security interest can be temporarily perfected, such as when collateral is transferred between states, or when a financing statement is filed within a specified period of time after the debtor takes possession of the collateral. For example, here, a debtor moves from one state to another with their car, which is subject to a perfected security interest. The creditor's security interest remains perfected for 4 months after the debtor moves, allowing the creditor time to perfect the interest in the new state. All right, more good stuff. We are doing it. We are powering through and having a good time. Talking more about perfecting a security interest by filing now. Perfecting a security interest by filing involves submitting the financing statement to the government, the public office. This is going to establish priority over subsequent claims. And that financing statement has to have the following. It's got to have the name and mailing address of the debtor and the secured party. It's got to have an indication of the collateral covered. It should include clear indication of the specific collateral, and then a general description of the type of collateral. I'm kind of rushing through that because what here we're going to see is that the UCC actually does not require the financing statement to include specific details about the purposes of the transaction or the quantity or amount of goods involved in the transaction. When I learned this back in school, I thought that was a little strange. Why don't you have the quantity or the amount of goods involved? That's a little odd. The description of the collateral should be reasonably identifiable, but it doesn't have to be exhaustive or overly detailed. Now, for example, a financing statement could describe the collateral as all inventory, all equipment, or all accounts receivable. Such general descriptions are considered sufficient under the UCC, even though they don't specify the precise quantity or amount of goods. The primary purpose of the financing statement is to provide public notice of the security interest, and the UCC deems general descriptions of the collateral sufficient for this purpose. I'm not the one making the rules, I'm the one translating them for you. This is what we have to see here. Now, the debtor must authenticate the filing by signing the financing statement, which demonstrates their agreement to the security interest. Once this is filed, the financing statement is effective for 5 years and can be renewed if necessary. If the financing statement is filed before all steps for attachment are complete, the security interest will not be perfected until attachment occurs. However, once perfected, the priority of the security interest will date back to the date of filing, which helps protect the secured party's claim against competing interests. Now, filing a financing statement is a crucial step in perfecting a security interest, as it will establish the secured party's priority over other creditors, provides public notice of the claim, and helps ensure the enforceability of the security interest. And important to understand what gets you into the party, and then what gets you in front of other people in line at the party. That's, I think, a great analogy way to think about it. For example, filing a statement here, this doesn't get you into the party, but this gets you, once you're in the party, in front of the other people at the party, or the other creditors. We got a nice recap here. Let's take a look at everything about perfecting a security interest by filing. Now, the primary effect of perfecting a security interest through filing a financing statement is that the secured party gains priority over most creditors who acquire a security interest in the same collateral after the filing. This means that if the debtor defaults on the loan, the secured party who perfected their security interest will have a higher claim to the collateral than most subsequent creditors. However, there may be exceptions, such as subsequently perfected PMSI in inventory under certain circumstances. Perfecting a security interest does not give the secured party permanent 100% priority if the collateral is moved to another state. In such cases, the secured party typically needs to file in the new state for protection to last beyond 4 months. Moreover, perfection generally lasts for 5 years unless extended. Perfection, this is going to be relevant to a secured creditor's rights against third parties who might also have an interest in the collateral. A secured party's rights in the collateral as against the debtor are established through attachment. The debtor is not necessarily protected against all other parties who acquire an interest in the collateral after the filing. While the secured party who obtains perfection gains priority over most parties, there may be exceptions, such as a buyer inventory from a seller in the ordinary course of business, who will likely have rights superior to the secured party's rights. In summary, perfecting a security interest by filing the financing statement under the UCC Secured Transaction Article provides secured party with priority over most subsequent creditors, offering them a higher claim to the collateral in case of the debtor's default. This is going to help to protect the secured party's investment and increase their chances of recovering their loan. Now we're going to talk through perfecting a security interest by taking possession. One way to perfect a security interest is by taking actual possession of the collateral. This method of perfection is often used for tangible assets, such as equipment, inventory, or other types of goods. Taking possession of collateral, it's a common method for perfecting a security interest. We've seen a few other methods as well. This establishes priority over other creditors who may have an interest in the same collateral and provides tangible evidence of the creditor's security interest. Now, when a creditor takes possession of the collateral, it establishes a first-in-line position, which means that the creditor has priority over the other creditors who may have an interest in the same collateral. This is because possession is visible and tangible. You can't get much better than having the actual physical asset. Evidence of the creditor's security interest in the collateral, which makes it easier to establish priority over other creditors who may have only filed a financing statement. Now, to perfect a security interest by taking possession, the creditor must have actual physical possession or control over it. This means that the creditor must have the ability to move, sell, or dispose of the collateral, and must be able to prevent the debtor from using or disposing of the collateral without the creditor's consent. That would defeat the whole purpose if you don't have full control of it, the ability to sell it at your own will. The process for taking possession can vary depending on the type of collateral involved. For example, if the collateral is equipment or other movable goods, the creditor may physically take possession of the items and store them in a secure location. Alternatively, the creditor may take possession of documents that control the disposition of the collateral, such as a bill of lading or warehouse receipt. It's got a piece of paper. It can't leave the warehouse without that piece of paper, the authorization. That's what we're talking about there. Now, it's important to note that the creditor must also comply with any applicable legal requirements when taking possession of the collateral. For example, if the collateral is held by a third party, such as a warehouse or storage facility, the creditor may need to provide notice to the third party of its security interest in the collateral in order to establish priority over other creditors. Basically, don't break the law when you're doing this. Now, another way, and some of these are similar as we see, but they are actual different methods, right? So by control versus by possession, similar here, but technically they are different. That's why we're going through this and all these different steps. Another way to perfect a security interest is by establishing control over the collateral. This method of perfection is often used for certain types of intangible assets, such as securities or deposit accounts. So basically the same thing, except we're dealing with intangibles now. Control is defined differently depending on the type of collateral involved, but generally means that the creditor has the ability to dispose of the collateral without the debtor's further consent. Now, for example, control over a deposit account may be established by having the bank agree to follow the creditor's instructions regarding the account, or by having the debtor agree to a control agreement that gives the creditor the right to direct the disposition of funds in the account. You're handing over the keys of your Fidelity account to the creditor. Establishing control over collateral, highly effective method of perfecting a security interest. Again, just like a possession, this is going to provide a visible and tangible way to demonstrate the creditor's security interest in the collateral and can provide additional protections for the creditor. However, it's important that you are following the proper protocol, doing this legally, to make sure it's properly perfected. Automatic perfection. All right, we got all these methods. We'll be done with it soon enough. Don't you worry. Perfecting a security interest by automatic perfection is a method that occurs automatically without any further action required by the creditor. This method of perfection is typically available for certain types of collateral, such as after acquired property or proceeds from the sale of collateral. For example, if a creditor has a security interest in after acquired property, such as inventory or AR, the security interest is automatically perfected as soon as the debtor acquires rights in the property. Similarly, here, if a creditor has a security interest in the proceeds from the sale of collateral, such as the sale of a vehicle, the security interest in the proceeds is automatically perfected for a limited period of time, which is typically 20 days, after the debtor receives the proceeds. Automatic perfection, it's a convenient method of perfection because it eliminates the need for the creditor to take any further action to perfect the security interest. However, it may not provide the same level of protection as other methods, such as taking possession or establishing control. Moving on and seeing some more here, we've got PMSIs, small scale assignment of accounts. What are these? We're going to dive into them even further. Perfecting a security interest is an essential step, as we've mentioned time and time again. Make sure you understand all of the various components here. You want to make sure you have priority over other creditors. In some cases, we can have this automatically perfected upon attachment without the need for further action. There are two types of automatic perfection. We've got PMSI in consumer goods. This refers to a security interest in which the collateral consists of consumer goods purchased with the funds provided by the creditor or the credit extended by the creditor. In this situation, the security interest is perfected automatically upon attachment, which means that the creditor does not have to take any additional steps to perfect their interest in the collateral. Example here, Jane buys a refrigerator for her home using a loan from XYZ financing company. This XYZ finance retains a security interest in the refrigerator as collateral for the loan. Now, because the refrigerator is a consumer good and XYZ has a PMSI in it, security interest is automatically perfected upon attachment without any further action by XYZ Finance. Next up, small scale assignment of accounts. When a debtor assigns a limited number of AR to a creditor, the security interest in those assigned accounts can be automatically perfected. The specific requirements here for a small scale assignment to qualify for automatic perfection may vary by jurisdiction, but generally it applies when the number of assigned accounts is relatively small compared to the debtor's overall AR. Just another note on the PMSI up here. Basically thinking this is a purchase in the ordinary course of business, and this is to help facilitate transactions. If you don't pay for what you just bought, they have an automatic right to take it back. That's what's going on there, which makes sense. If you buy it in cash, okay, cool, right? You bought it in cash, transaction's done. But if you're financing it and you just end up not paying for it, then the company can take it back. Now, an example of a small scale assignment of accounts here, Company A assigns 5 of its accounts receivable to Bank B as collateral for a loan. I mean, these could vary in dollar amounts, but let's say it's a $10,000 AR, a $5,000 AR. Doesn't matter, but just know that that's what we're talking about here. The assignment of these accounts receivable is considered a small scale assignment. In this case, the security interest in the assigned accounts is automatically perfected upon attachment without any further action by Bank B. All right, looking good. Nothing too wild here. You got this. Now we see temporary perfection. Perfecting a security interest by temporary perfection, method of perfection that provides a limited period of perfection without further action required by the creditor. This method of perfection is typically available for certain types of collateral, such as goods that are in transit or that are temporarily in the possession of a third party. For example, if a creditor has a security interest in goods that are in transit, such as a shipment of goods being delivered by a common carrier, the security interest may be temporarily perfected during the transit period without any further action required by the creditor. Similarly, if a creditor has a security interest in goods that are temporarily in the possession of a third party, such as goods being held in a warehouse, the security interest may be temporarily perfected during the period of possession without any further action required by the creditor. Temporary perfection provides a convenient method of perfection for certain types of collateral, as it is going to eliminate the need for the creditor to take any further action to perfect the security interest. However, it may only provide a limited period of protection, and the creditor may need to take additional steps to perfect the security interest once the temporary period has ended. We got a couple examples here. Let's run through perfecting a security interest. It's the process of providing public notice of the creditor's claim in the collateral, priority over other creditors. You're going to remember that. You're going to memorize that. Specific situations here for perfecting a security interest: the 20-day period for trade-in. When a debtor trades in the original collateral for new collateral, the security interest in the original collateral is continuously perfected for 20 days after the trade-in. Now, this means that the creditor's security interest in the new collateral is protected during this 20-day period without any additional steps required for perfection. Example here: a debtor trades in their old car for a new car at a dealership. The creditor's security interest in the old car is continuously perfected for 20 days after the trade-in, which also applies to the new car during this period. Next up, if perfected, it reverts back to when the debtor obtained possession. If the creditor perfects the security interest within that 20-day period mentioned above, the perfection is considered to have been effective from the date when the debtor first took possession of the collateral. Example here: the creditor perfects their security interest in the new car on day 10 after the trade-in. Since the perfection occurred within the 20-day period, the perfection is considered effective from the date the debtor took possession of the new car. And then we've got, lastly here, moving states. When a debtor moves from one state to another, the perfection of the security interest continues 4 months after the move. To maintain the priority of the security interest beyond this 4-month period, the creditor must perfect the security interest under the laws of the new state. In this example, a debtor moves from state A to state B. The creditor's security interest, which was perfected in state A, continues to be perfected in state B for 4 months after the move. To maintain the priority of the security interest beyond the 4-month period, the creditor must take the necessary steps to perfect the security interest under state B's laws. All right, just more points about this. And taxes will always be more important, but here, I'm an expert at this. Get a few more points on the exam. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.